If you run a business in the UK, tax can feel like it's working against you, but it doesn't have to be that way. In this video, I'll show you as a founder how to keep more of what you earn, stay on the right side of HMRC, and stop tax catching you out with real 2026-27 numbers in plain English. And by the end, you'll know what you can keep, what you can claim, and what to watch out for. Wherever you are now in your founder journey, there's something in this video for you. If you've been running your business for a while, a few of these things might have caught you out already, so you'll be prepared for next time. If you're just getting started, these are the foundations to get things right from day one before they cost you anything. And if you already work with an accountant, this gives you the questions to bring to your next conversation with them. I'm David, I'm a chartered accountant and the founder of Car Accounting Studio. I'm ex-Big Four, I've worked at a fintech and ran a software company, and now I work with founders every day, hands-on with FinOps, accounts, and tax. This video is in 3 parts. Keep more, the money you're probably leaving on the table. Stay safe, the handful of things that cost you if you get them wrong. And stay calm, how to set things up so tax never surprises you again. One thing before we start, I'm an accountant, but I'm not your accountant. This is general information, not advice. These are UK figures for 2026-27, correct at the time of recording. They change and your situation may differ. If something resonates, go and check it properly. So you want to keep as much of the money that you make as you can. How do we do that? So there's 2 key parts to this, salary and dividends. Let's put some real numbers on it. Meet Jordan, indie SaaS, one-person limited company, and this year the business makes £50,000 in gross profit before Jordan takes anything out. Jordan wants to take the lot. So first, a salary of £12,570. That's the personal allowance. No income tax and no employee national insurance at that level. Now, the company pays employers national insurance on most of that salary. So for a one-person company, that comes to about $1,100. But there's a bit that's easy to forget because it only really becomes visible after the end of the year. The company pays corporation tax on its profit before Jordan can take dividends, and that's about £6,900. What's left after that can come out as dividends, £29,400. The first £500 of dividends to Jordan is tax-free, and the rest is taxed at 10.75%. So the dividend tax is about £3,100. If we add it up, Jordan keeps £39,000, and the total tax, including employers, national insurance, corporation tax on the company, and dividend tax personally, is about £11,100. On 50k of gross profit, that's an effective tax rate of about 22%. So the full picture is a couple of tax numbers stacked together. For a one-person company, don't ignore the corporation tax to make the take-home look bigger than it really is. You might hear people say, take £12,570, pay no national insurance. So that's half true. You pay none, but your company pays that $1,100 of employers' national insurance because a one-person company can't claim the employment allowance. You need a second person on payroll for that. Something else you might hear, a hack to drop to £5,000 salary to dodge the employer's national insurance. But if you look at the numbers, the £12,570 salary still wins, and by about £460 a year. That's because the extra national insurance is actually tax deductible to the company, and the corporation tax relief on the biggest salary more than covers the extra NI. But there's a bigger reason than the £460. A £5,000 salary is below the lower earnings limit of $6,700. If you're earning less than that amount, that year doesn't count towards your state pension. So at $12,570, you earn the qualifying year. Drop to 5k and you've given that up as well as paying more in corporation tax. Let's take a bit of a different look now into the money you might be leaving behind. There's a bunch of completely legitimate tax perks or benefits that if you're not aware of and you're not claiming, you're just leaving money on the table. Let's look through them. Trivial benefits. Your company can buy you small gifts, up to £50 each time, up to £300 a year as a director. Not cash and not a reward for work, not in your contract, but within those rules it's tax-free. The staff party, up to £150 a head on an annual function. There is a bit of a catch though, more on that in a second. Equipment, a laptop, a monitor, a desk, a chair, It's tax-free whether the company buys it directly or new for this year if it reimburses you for the kit that you bought yourself. Just keep it for work with private use minimal. Your phone. One mobile on a company contract is fully covered. The device, the plan, and all your private calls are tax-free too. Pension. Your company can pay into your pension directly, usually up to £60,000 a year, with no personal income tax, plus it's corporation tax deductible for the company. This is one of the most efficient ways of taking money out, and you sort of get to like double dip. There's no income tax personally, plus there's a tax deduction in the company. So if you've got excess profits in the business, this is a great thing to do with them. And here's one not to miss. It just changed recently. HMRC raised the mileage rate for the first time since 2011. It's now 55p a mile for the first 10,000 business miles in your own car. And that's backdated from April. Many of the online calculators still show the old 45p. It's the first change in 15 years. HMRC finally moved up a gear. But enough of the seriousness, back to the party, because it has a sting, and I do not mean the effects of too much alcohol. The £150 is a cliff edge. £150 a head and you're fine. £150 plus 1 penny and the whole cost becomes a taxable benefit, not just the extra. So that's probably the most expensive penny in UK tax. If you work from home, and most one-person companies do at least some of the week, there's a simple tax-free payment a lot of directors never set up. Your company can pay you £6 a week, about £300 a year, towards the extra household costs of working from home. It's tax-free for you, no receipts needed, and the company normally gets corporation tax relief on it too. How does it work? It's per person, not per company. If you and your spouse are both directors and you both genuinely work from home, that's £6 each. You don't need to be working from home full-time, but it does need to be a genuine, regular pattern. This flat rate covers the extra costs of working from home, like your electricity, your heating, or your cooling if you're lucky enough to have air conditioning in these heat waves, rather than being a claim for your actual household bills. There are some more involved options like renting workspace in your home to your company, but these raise some extra tax and property considerations. So for most directors, the £6 a week is the simple low-risk one. Just set it up and it runs. So that's a quick spin through the main ways you're probably leaving money on the table. If any of these have pinged your radar, I've built a free 2-minute founder tax check. It runs through these things and a few more, flags where you might be overpaying HMRC, and emails you your results. Link is in the description. Now, the part that costs you if you get it wrong. The VAT threshold is £90,000. The mistake is thinking that it resets every April like your tax year. It doesn't. It's like your coattails dragging behind you, looking back over the last 12 months, rolling every month. If you cross £90,000 on any rolling 12-month stretch, you have to register and right away. If you miss it, HMRC might bill you for the VAT you should have been charging your customers, backdated, plus a penalty. So for a SaaS or a service business that's growing fast, this one definitely sneaks up. Now, a dividend can only come out of profit the company actually has after tax. If you take one where that profit isn't there, then the law doesn't treat it as a dividend at all. It might treat it as a loan from your company to you. And HMRC can charge you for borrowing that money. To steer clear of this, if your director's loan stays under £10,000 across the whole year, then there's no benefit in kind to worry about. But if it's still owed back to the company 9 months and 1 day after your year end, the company pays a tax charge of 35.75% on it. You can get that back once you repay the loan, but that's your cash locked up with HMRC in the meantime. People always wonder what triggers an HMRC investigation, and is this about one number or more about patterns that don't add up? So here's 6 common ones. Margins that are out of line with your sector, expenses that look too high for your turnover, a lifestyle that doesn't match your declared income, income that isn't declared at all, filing late or inconsistently, and unusual cash patterns. So none of that is an official published checklist. I'm not claiming to have HMRC's playbook, but it's about the pattern. If your numbers tell a story that doesn't hang together, that's what draws attention. If you keep them clean and consistent, then you're not the one that's interesting to HMRC. Right, this one's free and a lot of founders don't do it. When you set up a company, your home address often ends up on the public register. One search and anyone can find where you live. You can change the registered office address going forward with a form called AD01. That's free and it stops your home showing on future filings. If your home address is already shown on older filings, you can apply to suppress it using a form called SR01. That one costs £34 per document that you need it removed from. £34 per document is not particularly cheap, but it is cheaper than moving house. So steer clear of those and you keep what's yours. Last part, how to make tax the most boring part of your business. So this is one that catches out founders emotionally. Your profit and your bank balance are not the same number. If you think of your profit and your loss as the scorecard, it tells you how the business performed. And your bank balance is what's actually in your pocket right now. So January self-assessment tax payment deadlines hurt for people who buy themselves things from the cash in their pocket because some of that money was never actually theirs. It was HMRC's, just sitting in their bank account, asking to be spent. So like so many things in life, the fix is dull, but it works. A separate tax pot. So when money comes in, move a slice of that cash into a separate bank account and don't touch it. Yes, my big secret is a second bank account. Peak accountant. How much to set aside? It depends. For corporation tax, it should be on your profit. So if your books are up to date, you might be able to look monthly and make an estimate of how much profit you've got, and then set aside corporation tax at 19 or 25%, depending on how much profit you make. If you're VAT registered, you might want to put the VAT aside as well. If you're drawing dividends throughout the year, you might personally want to put that dividend tax amount into a separate savings account. The whole idea is just being that when the tax bill comes, the money's already there. No scramble, no surprise, and no stress. There are a few dates to be aware of. They're all a bit random as well. Corporation tax is due 9 months and 1 day after your company year end. VAT. Each business has a different quarterly stagger, and you have to pay and file 1 month and 7 days after the end of your quarter. If you have a payroll, it's monthly. Your confirmation statement is due at Companies House once a year to confirm your details are right. And if you're in self-assessment, the deadline is 31 January. You might also have a mid-year payment on account due 31 July. And if your self-employment or property income is over £50,000, Making Tax Digital for Income Tax started on 6th of April 2026. So you're filing that quarterly, but there are no quarterly payments. Put your dates in your calendar with a reminder about a month before each to help cut down on the surprises. Maybe treat them like dentist appointments. Sure, they're not fun, but they're scheduled and they're so much worse if you skip them. Last one, because everyone asks it. Should I go limited? So the short answer from my perspective, like if you're just getting started, if you're making less than about like 35K and spending all of your profits to live, then no, just stay a sole trader. At that level, it's actually a bit cheaper in tax to stay a sole trader and it's less work, especially if the business doesn't end up working out. But going limited has some real benefits. So limited liability protects you and your assets. You get a lot more flexibility with how you manage your profits, and it might give you more commercial credibility. Decide based on those. So keep more, stay safe, stay calm. That's what being a founder who's in control should feel like. And if you want to know where you actually stand, I built a free 2-minute check. You answer a handful of questions about your setup and it flags what's worth a closer look for you, then emails you your results. Link in the description. And if this was useful, subscribe for more.